All right, good Monday morning, traders, investors. Welcome to another trading week. It is Monday morning. It is almost 6 o'clock a.m. Eastern time. Futures markets are open and trading, and it looks like we've got slightly lowered bids here on equity futures. The VIX is ticking higher as well this Monday morning, but actually I would venture to guess the VIX is truly down. It's not up. Remember what Monday is, and if you don't know what Monday is as it relates to the VIX, maybe we'll have some time to get to that later. There's a teaser, so stick around. Anyways, with that being said, kind of wanted to go over some useful, maybe helpful, insightful charts here this Monday morning in an article that we send out to all of our basic members on Mondays. It's a free article, if you will. It's called the Weekly Nifty 9, and the Weekly Nifty 9 are kind of the favored or best charts and analysis from within our weekend research report that goes out every Sunday. If you are not subscribed to Finom Group, join us quickly so you can get all this content every week. Again, our basic membership is free. You'll get the Weekly Nifty 9. If you do want our macro market research reports and our state of the market video, macro market research report comes out Sunday. Our state of the market video comes out every Thursday. If you want those in real time, just sign up for the contributor membership. If you want to trade, invest, get all of our ideas and analysis, sign up for the premium membership at $59.99. We have a live trading room, private Twitter, all the goods for $59.99. All right, with that being said, let's take a look at our weekly Nifty 50, weekly Nifty 9 here for this week. Our first chart, our research report excerpt is, it is important to note, however, that with the aforementioned economic conditions, they were almost always accompanied by a sharply rising unemployment rate. So you probably want to know what are we talking about when we talk about the economic conditions? Well, we know that all year long, well, pretty much all last year, it seems like recession is imminent. It's imminent. Okay, it didn't come this last quarter. It'll come next quarter, and they just keep pushing it out and pushing it out and pushing it out. But in this commentary here and the chart, what we are recognizing is that all recessions of the past came with a rising unemployment rate as well as declining consumer spending, none of which are happening right now. This chart is personal consumption expenditures. There's not even the slightest of dip right now. And we know that the unemployment rate is lower than it was a year ago. You want a recession, you got to get these two things moving, in the direction that you would tend to see them going into a recession, if not already in a recession. Here's another excerpt. This is from the Philly Fed manufacturing indexes. The indexes for new orders and shipments both actually increased for the second consecutive month, but they do remain in negative territory. This is the current activity for the diffusion index within the Philly Fed manufacturing index, which is a regional purchasing manufacturing. It's soft data. It's a survey. How do you feel? What do you think? I do not favor soft data, as most of you know. So we did have a spike here, or an inflection to the upside, pretty big one as well. So within our research report, we're just denoting the fact that while still in contraction territory for the Philly Fed manufacturing index overall, some of the subcomponents did take a nice tick higher. The overall Philly Fed manufacturing index ticked higher as well, but still remains in negative territory. Everybody said, well, where we see the ISM, which is the Institute for Supply Management manufacturing index right now, is usually accompanied by a recession. While that may be true, again, even the ISM, which is considered the kind of the model for our manufacturing index for the United States, is just a survey. It is just soft data. If we look at the actual hard data, new orders, right? New orders which are a component of the ISM, but total new orders across the United States, not just the ISM's data, but all actual new orders, we are still positive here year to date as of March. Is it, is this the direction we wanted heading in? No, but it is still positive. So while manufacturing surveys, all the manufacturing surveys point to a manufacturing recession in the United States, the actual new orders, what matters most, new orders for manufacturing, goods, services, blah, 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 are actually positive. So do keep that in mind. All right, moving on. One of the other things that we've long since understood is if you want to get a recession, you've got to kind of hurt the consumer, right? They say don't bet against the American consumer. And if the American consumer has a healthy balance sheet, more than likely there's healthy spending, there's healthy jobs growth, there's healthy, you name it. This is a chart that I had created many months ago. But in reality, this is kind of my go-to so far as, look, if we're going to have a recession, we're going to have a recession. But the depth of the recession may be a good tell of the potential depth of that recession. I would go to the household debt services payments as a percent of disposable personal income. This is essentially what I call the household balance sheet. And if this is in healthy shape, the economy is going to have an extremely mild recession if a recession comes. And what we're showing here is this was the great deleveraging period, post the great financial crisis. Essentially, the consumer had way too much debt as a percentage of disposable income. Their bills were too high on a monthly basis. They had too much outstanding debt, whether it's credit cards, mortgage, revolving debt, student debt, whatever it is, there was too much of it to support disposable personal income, discretionary spending within the economy. And as you can see here, right now, the household debt service payments are extremely low relative to disposable personal income. In fact, it's the lowest on record. So when people say, well, there's too much consumer debt out there, relative to what? Relative to what? It doesn't matter how large the debt is. Debt generally goes higher over time. That's how our financial system, that's how our economy, it's what it's based on. Remember, more people have paychecks, they can sign up for more credit cards, they can buy a home, and then they have a mortgage. There's good debt and there's bad debt. This is one of the ways that we decipher between the two. Every month, well, no, I'm sorry, every quarter, the New York Fed comes out with with data regarding household debt. And within that report is the percent of balance 90 plus days delinquent by the different loan types: credit card, student loan, mortgage, auto loan, revolving. And what we're looking for within the data here is whether or not the consumer is paying their bills, at the end of the month. Because if they're not, it will show up here. So we're looking at 90 days plus delinquency rates. We know the deal with student loan debt, right? The moratorium. So we don't even look at this at this point in the economic cycle. But credit card debt has been very healthy. Again, this is part of that deleveraging process we talked about earlier after the great financial crisis. It started to rise prior to the pandemic, right? And got all the way up here in 2021. Then it fell off again. This is good. It's telling us that fewer and fewer people are 90 days delinquent on their credit card debt. It's taken a tick up more recently, but we're still way below where we were going into the pandemic. Same thing with auto loans, higher going into the pandemic and on this trajectory. Then it dropped way off here in 2021 and a slight uptick here, but still below the pre-pandemic levels. More mortgages and revolving credit are still going down. So when people say, look at the amount of debt the consumer has, this is another chart that says you're looking at the wrong thing, or you have the wrong perspective. Pick one. You don't want to be in either, quite frankly. Wrong perspective, you know? All right, with that being said, let's move on. Okay, our fourth research report excerpt here speaks to the markets, market breadth, and you know, we know that's been a hot topic lately, or hot button lately here within market for market participants. So this is a earlier this year we had 3 breath thrusts fired in January. January 12th of this year, the breakaway momentum breath thrust signal that was coined, studied, and offered by Walter Deemer, a famous technician, many years ago. And what he found is, when this certain dynamic in market breadth signaled, there were usually very good returns going forward. And that's basically what this speaks to, how the S&P 500 performed after a breakaway momentum breath thrust, or I call it the BAM, breakaway momentum, an acronym BAM. And you can see here, and now this happened back in January. So if we fast forward, now what February, March, April, May. So it's been 4 months since the BAM fired. 3 months later, 92% positivity rate. The average return is about almost 8%. 6 months later, 96% positivity rate. This gives us an idea. Historically, after this kind of breakaway momentum breath thrust, forward returns are mostly positive. I mean, 96% of the time. The only time it was negative was 1992. 6 months later, we are 4 months later, right? So at the time that this signaled, the S&P 500 was 3983. We hit 4,200 last Friday. So far, so good. We do have a debt ceiling issue on the horizon. Could that prove a disruptor? I'm willing to bet there were debt ceiling issues in the past, folks. We all know there were. So we'll see. We'll see. It's very doubtful. Essentially, how I utilize these kinds of market internal breath thrust signals, it's not so much for me. I recognize the positivity rate going forward. That gives me an idea of the probabilities. Number 2 is when markets consolidate, and for whatever reason, because they will consolidate, especially early on after the signals. Think about what it takes to get one of these signals. That's a lot of momentum. It's a lot of strength in the market. More than likely, it's a lot of good market breadth. But that doesn't, market's not going to go up in a straight line. You're going to get some degree of consolidation. What these types of breakaway momentum breath thrusts inform us about is how to engage the market when it does consolidate. It's kind of a buy the dip signal, if you ask me. So breakaway momentum by Walter Deemer informs of the probabilities going forward, as well as how to behave, how to engage consolidation. All right, research excerpt number 5. Last week, as I offered on Twitter, with that achievement above 4190 and 4200 in the S&P last week, we also retraced 50% of the decline from the bear market. And that is a big undertaking from the market. Usually, that is a sign of a new bull market, and usually the market never makes a lower low. Keep in mind, this 50% Fibonacci retracement of the bear market is on a closing basis. We closed at 4198. We got above 4200, but on a closing basis, 4198 did capture the 50% Fibonacci retracement rule, we'll call it, because historically, only one time in history, after a 50% Fibonacci retracement of a bear market, Did we ever make a lower low? That's what this table down here from Carson Wealth Research, that's what this informs. Only one time in history did the market make a lower low. Do you know when that was? That was in 2022, last year. This has happened 16 times now, but only once did the market make a lower low, and that was last year. And you know what it took? It took Jerome Powell basically taking a sledgehammer to the markets at the Jackson Hole Summit. Essentially, he said, sorry, guys, I know you're in rally mode. We got all the way above 4,300 after dropping to, I think, 37.85. We rallied all the way to 4,300. Jerome Powell said, no, we've got to keep hiking rates. I'm sorry, but, and the market tanked. Market made a lower low. But that's what it takes, kind of an exogenous event. That speech by Jerome Powell in August of 2022 was essentially an exogenous event. The market thought we're under control. We're actually in a disinflation period, so the Fed shouldn't have to hike that much more. But Jerome Powell said no. The market was right, by the way. We were in a disinflation period. We're still in a disinflation period. We've gone from a peak of 9.2% on the CPI to just under 5% we learned a couple weeks ago. Sometimes the Fed gets it wrong. All right, let's move on. Research report excerpt number 6. This is a study, and I thought this was an awesome study because we had touched on this many times in the past. This is a buy the dip market, folks. You've had ample number of times to buy the dip this year over the same price range. Right? We had been stuck in this price range from, let's say, 3,800 to 4,200 for weeks, if not several months on end here in the new calendar year. What this study shows from Fundstrat, led by Tom Lee, is you can actually set certain criterion to surmise what the buy the dip environment is like. And so that's exactly what they did. They discovered that there have been 60 buy the dip market environments going back to, I think, 1928. Since 1928, the regimes and resulting annualized returns are as follows. Buy the dip has had a regime 60 times, and the average annualized gain, was that Macaulay Culkin from Home Alone? Buy the dip 60 times, and the average gain for the annualized average gain is 28%. In a sell the rip market environment, which has happened 30 times since 1928, you have a negative 25% annualized return. And that's what last year was all about. I mean, it was perfect. Peak to trough, closing basis, peak to trough last year was 25% decline. The criterion that they put, to define these regimes was if the market falls, S&P 500 falls 2% in 5 trading days, but then recaptures greater than 2% within 20 trading days or a month, it's about 22 trading days in a month, then it's a buy the dip environment, because that is a quick recovery. Greater than 2%, you recover greater than 2% within 20 trading days. And these are all the occurrences since 1928. What's interesting to note is only 1, 2, 3, 4 times during a buy the dip regime did you have a negative annualized return. 1%, 5%, 3%, and they're very muted, annualized negative returns. But the last one was 1992. So in all buy the dip regimes since then, the market has been positive. And again, the average return in a buy the dip regime for the year, 28%. Moving on. Number 7. This is a chart of the Nasdaq 100. What has proven to be the strongest of indices in 2023? It's the Nasdaq 100. It's even outpacing the Nasdaq itself. It's a more concentrated index. It's only 100 stocks. And they are the best of the best of the best of the best. For those of you who like Men in Black, remember that movie? The best of the best. All right, this is showing the new highs minus the new lows, otherwise known as net new highs or net new lows, depending on which is greater. And what we've seen is throughout this regime, here's starting the new year, if the candlesticks are to the upside, that's net new highs, meaning new highs are outpacing new lows for that trading day. We've had many new high days, net new high days, than we have had many net new lows. One of the things that I've been talking about with Finom group members in our trading room, as well as in this weekend's research report, official research report, is that the Nasdaq 100 and Nasdaq, for that matter, are overheated. Both finished above their upper Bollinger Band, which is a sign of overheated, overbought, overextended conditions. But look at this spike here in net new highs. I mean, this is the greatest number of net new highs that we've seen on back-to-back days in more than a year. This is a one-year chart of the net new highs. And, that's, again, usually a sign of overheated conditions. So just a heads up there. If we see some consolidation, in certain areas of the market, in certain indices, it should come as no surprise. Research report excerpt number 8, again, dealing with the Nasdaq 100, the new 52-week high, because the Nasdaq 100 had a new 52-week high last week, meaning it has not hit a higher high in 52 weeks. It's the first time it's done that in more than 6 months. And here's all the data when it happens for the first time in more than 6 months. Historically, again, I go to what's the percent, the forward, performance of that index, and this is going forward 1 month, 3 months, 6 months, 12 months. 78% of the time, the Nasdaq 100 is positive after making a 52-week high in more than 6 months, for the first time in more than 6 months. 3 months later, it's higher 85% of the time. 6 months later, 80%. It has never been lower 12 months later. Again, so what do you do when NASDAQ consolidates? You want to buy that dip because these are very high probabilities that the NASDAQ 100 is going to be higher in price going forward. And last but not least, number 9. This is our weekly Nifty 9 report that goes out to all of our basic members Monday morning. This is the Qs, or the NASDAQ 100 ETF versus the Dow Industrial Average ETF. Another way that we can decipher whether or not the NASDAQ 100 is overheated on a relative basis, relative to what the Dow is, look at the RSI, folks. In this performance ratio, it's 78. So the Dow has materially underperformed, as we can tell here, the NASDAQ 100 since the beginning of the year. How things change as the calendar year change. We're often told, well, just because the calendar year changes doesn't mean the market changes its trend. No, actually, more often than not, that is exactly what happens. More often than not, the calendar rolls over to a new year and the entire environment changes. It just, think about the January effect. It's called the January effect in market colloquialisms because things do change in January. And this is a perfect example. When the new year changed, we have a changing character of the markets where growth, NASDAQ 100, FanMag became leadership and outperformed the Dow itself. But man, a 78 RSI is very overheated. This is the 14-day RSI. And usually when you get to 70, that is an overheated condition. Doesn't mean, this performance ratio can't go higher, because obviously it does. But this is an area where things are getting overextended, and you're that much closer to probably having an interim top, whether it's in the index or a relative performance ratio. You're generally getting that much closer to the top, an interim top, not an ultimate top, whereby you do get some consolidation thereafter. All right, a couple more things I wanted to touch on before I say have a great trading day. Let's go to my Twitter homepage. I follow all of the Wall Street strategists and analysts, especially the most high profile ones. One of the things that I said late last year, this was an interview with Savita Subramanian. She is the head or lead strategist for markets at Bank of America. And I basically said, you're going to want to save this one, folks. It has happened to Savita every single time in the past, and no reason to see why it won't happen again. In this interview, which you can check out for yourself when you have the time, she's basically saying next year is going to be a bad year also. You can expect the bear market of 2022 to continue into 2023. And what I was saying is, you're going to want to save this, folks, because it happened to her every single time. What has happened to her? She stays bearish, the market changes its character and becomes more bullish. It's not because she's an actual strategist. It's not because she's qualified. It's because she's a perma bear. And this is what perma bears do. They're always bearish. They're always cautious. Nothing good's going to happen in the economy or the markets. They're always looking down, and they can't see up. They have no ability to do so. I'm not that smart. I can't predict the future, but I know these folks. And that's why I warned you. You're going to want to archive this, because more than likely, if it happened in the past, and we know the markets are a good extrapolation of human behavior, it's going to happen to her again. Lo and behold, 2022 turns to 2023. She's still bearish. The market turns bullish. And I don't know where we're going to finish the year, but I know human character doesn't change all that much. And she didn't, and she's paying for it. But as of this weekend, in her most recent notes, New Year end price target 4,300, range 3,900 to 4,600. So basically, she's raising. We raise our S&P 500 2023 year-end target from 4,000 to 4,300. Well, looky. Somebody caught religion, because she was wrong. And I knew she was going to be wrong. It's happened to her every single time in the past. All right. It's not just her. And again, as I said before, I follow these strategists. This is Mike Wilson. Mike Wilson is probably even more bearish historically. Again, that's just who he is. He is a perma bear, just like Savita. And I warned folks in November. I went back into my archives of Morgan Stanley reports to find this one from November of 2018. For most of you who remember your market history, we had a real nasty bear market in 2018 in the fourth quarter. We dropped 20% intraday. And then we rallied, coming back from Christmas, we rallied into the new year through January. We had several breath thrusts that happened then as well. But indeed, I was accurate. Mike Wilson just reiterates the same perma bear mantra, which didn't continue in 2019. What am I talking about? Well, here's November, the 2018 report, where he gives his 2019 outlook. For 2019, we see more of the same at the index level, with the S&P 500 likely to continue its broad consolidation of the secular bull market. As a result, our base case, meaning their price target, their actual price target, is 2,750. The worst case, bear case, is 2,400, and the bull case is 3,000. But they believe, which is their base case, 2,750. In other words, no change from 2018 into 2019. As we all know, and this again, so he was just going to continue with his bearish mantra through 2019. Here is that bear market, finished at 2416 on 12/17 or December 17th, 2018. And then it was, folks, rally mode, all of 2019. You had some dips along the way. We finished 2019 at 32.34. Could you imagine, if you followed Mike Wilson, if you followed Savita Subramanian, how much profits you would have missed out on, folks? Because they're not strategists. They're perma bears. And perma bears are going to do what perma bears do, which is constantly be bearish. And unfortunately, those who follow in their works will miss out on a lot of upside. With that being said, again, if you don't receive our weekly research report, sign up as soon as possible. And you'll also get every week our weekly state of the market. Not all of our content is free. You know, we do a lot of free YouTube videos, but then we have our weekly state of the markets that generally only go out to our subscribers. Unlisted, unlisted, unlisted. Some really good stuff in there, folks. Have a great trading day. Have a great trading week. Until next time.